Views expressed are solely those of the speakers and do not represent this show or its team.
This market seems like it has no direction, but it does have a direction, and that direction is up. I think everything seems like a crisis because, one, there's money in financial media turning everything into a crisis. And so a lot of this stuff that we deem are crises are really just noise.
Welcome to Built to Last, conversations about wealth, work, and life. Today, I'm happy to bring back as our guest, Gary Aiken, Chief Investment Officer for Concord Asset Management and Concord Wealth Partners. Gary, welcome back.
Great to be back, Wade.
Well, listen, I'm going to jump right into some tough stuff here. And I'm going to start out with basically some market context. And I need to know why this market seems so, I don't want to say conversational, but complex for everyone. You got a spin on that?
I guess if I'm thinking about it, this market seems like it has no direction, but it does have a direction, and that direction is up. And, when we came out with our forecast last year, we said it was going to be a grind, right? And when you're in the middle of, a grinding higher market, it just feels like, like anything could set off a big downturn, or we're too close to the end, or, sometimes if things are going too well for you in your life, the pessimistic person would always say, well, something's got to give. And, it can't be all roses like this. And
let me stop you. I want to ask you a question. Just why don't you get into what's the difference between market uncertainty and market risk? I mean, explain a little bit about those differences.
I think uncertainty is something that we're always present with. And uncertainty is hard to quantify.
Right.
And when we talk about risk, now we're putting quantifiables. We're putting numbers to that uncertainty.
Right.
Just saying uncertainty, everything is uncertain. Whether there's going to be traffic on the Beltway home, I don't know. I'm uncertain about that. But if I say, well, what's the probability that I get home in 30 minutes or the probability that I get home in 45 minutes? Now I've taken risk into the picture, and I can quantify that. And when we're talking about investing dollars for people, we're moving uncertainty, and we're trying to quantify that uncertainty so that we are defining what risks we view that are out there, and what scenarios, what we would do in different scenarios according to that. So,
well, if we look at it from that aspect, when does that turn into a crisis? And because why does everything seem like a crisis today?
I think everything seems like a crisis because, one, there's money in financial media turning everything into a crisis. Two, I think we live in a very polarized society. And so, just that polarization leads everyone to overreact to things. And I think also, there's definitely a management style change around the current administration. A lot of negotiations that are usually done behind the scenes in private are being done out in the open on social media.
Right.
And so everyone in the world gets to react, that it gets amplified, and it seems like more of a crisis around relatively mundane things.
Do you think that's what's driving? You think that's what's driving a lot of the volatility we see that just seems like it happens for a day and a half, and then we're back to looking at normalcy? Is that the answer to that?
I think so. I think in the short term, that's definitely the case. And so these 1 day, 2 day, over the weekend kinds of things that make news, drive markets, in temporary times, or in a short time span. That certainly was driving it.
Okay.
If we step back though, and we step back to sort of Concord's view, right? That we're grinding higher, but there's certain things that are going to be prevalent that are
Right.
longer term that we can trend back towards. The dollar is likely to continue to decline over time, and that's for a number of different factors. So even though there's a lot of volatility around that decline, the trend we think is still there for that.
Okay.
Are we still going to spend more and more money on information technology and information technology infrastructure? Yes. Are there news headlines around that? Are the players going to change over time? Are different investments, from different countries going to happen and drive news? Yes. But over time, that trend we think is still intact. So I think it's one of those things. There's that phrase, you need to distill the noise from the signal. And so a lot of this stuff that we deem are crises are really just noise.
Right. So let's talk about interest rates for a second. Why does it seem like, or do you agree or disagree with this statement, that interest rates seem to be impacting every asset class right now?
Interest rates have always impacted every asset class. And the reason that interest rates are so important is because the way that we value financial assets is by dividing cash flows by an interest rate. And that, some call it discounted cash flow valuation, like a DCF.
Yeah.
Some in real estate, it's a cap rate. You take your net operating income divided by an interest rate, and that's the value of the property. So interest rates drive asset valuations. And so the direction of interest rates, getting that right, is very important. So we start, a lot of our analysis based upon what do we think interest rates are going to do.
Well, I'm going to use the term higher for longer. Just throw that out there. What does that mean in practical terms?
From my perspective, I think higher for longer means that we're just not going back to the 0% interest rate environment that we were at for so long. Does that mean interest rates will be, going back towards 8 or 10%? I don't think so. I don't think there's reason to support that. But
what areas of the market, where do you see, let's focus on where you think the struggle is going to come in for certain sectors. Let's isolate that first.
I've got to say, I don't see a lot of struggles from an interest rate perspective.
Okay.
In almost any sector of the economy.
That's great news.
And the reason is that corporations don't have a ton of leverage. They're not using a ton of debt. Secondly, they refinanced a lot of their debt when interest rates were super low. And even when they're refinancing debt, it's not like interest rates are so high that it's going to be a major factor in whether they're profitable or not. And then finally, the GDP numbers that just came out for the final of the third quarter showed that nominal GDP was growing at like an 8% nominal rate year over year.
Right.
It's very, very hard to imagine that interest rates going up 1% or 2%, is going to impact a business's ability to refinance, pay its debt, or grow in the kind of environment where we are today.
Well, let's shift gears and talk a little bit about what are investors getting wrong? What are some common mistakes that you see occurring already beginning this year?
I think the mistake that investors make is thinking too short term and trying to game every one of these market moves. There's a great analysis that showed that a lot of the value creation in markets happens when markets are closed that because news happens,
Yeah.
at night, and that news gets factored in overnight into the opening bid.
Yeah.
So
exactly.
at 9:30 when the bell rings, that value gets reflected. And so if you're not in the stock overnight, if you're out of the market, you're missing a lot of that value creation.
Yeah, the overreactions are definitely, I don't want to say in our client base, of course, but overreactions can be a thing. But let's talk about, I still think there's some complacency out there. Do you believe that it still exists?
There's definitely complacency.
Yeah.
And some of that complacency is a hesitancy to believe that international markets are going to outperform U.S. markets over some extended period of time. Complacency around the dollar losing ground against other currencies. And you're starting to see some of that complacency be eroded in fund flows into international stocks, into international bonds, away from U.S. Stocks and bonds. Is there going to be a tipping point where all of a sudden, there's a rush for the exits from U.S. markets? I don't think so, because U.S. companies are still the most profitable companies. U.S. GDP is growing faster than China, and faster than Europe. So the U.S. is still an incredible place to invest, an incredible place to live, an incredible place to build businesses. So I don't think it's something where we're going to wake up one day and all of a sudden, we should have been 100% somewhere else.
Right. I agree.
But there's definitely some complacency in that the U.S. is the only place.
Right.
Because for 20 years it was.
Yep, I agree. But you know how I feel. When in doubt, S&P 500. But that's pretty easy, right? So
it certainly is, and there's nothing wrong with that approach either. Because if you look at the S&P 500, 55 to 60% of the revenues of big U.S. companies come from overseas.
Right.
So, if you don't feel like you want to buy Unilever stock, you can buy Procter and Gamble, and you're still getting, similar types of exposure. But Procter and Gamble is dealing with currency fluctuation and selling products all over the world.
Yep.
And so there's a lot to be said for, big U.S. companies who are global in nature, providing you diversification to markets outside the U.S.
Very few exist that don't have a footprint in other countries in today's world, which is one often overlooked, diversification part of the S&P 500 that I know we track and you track, and we look at, ex-U.S. or in U.S. companies when you break those down, which really helps when it comes to, segregating and how you pull out certain sectors in the S&P 500, because you've done a really good job of outperforming the S&P 500, over the last 3 years. So I want to commend you for that. We really appreciate that, as our investors do. But I do want to bring up one thing. I want to ask you an honest, your impression of tariffs in the beginning of the year to your impression of tariffs now. Has it changed? The outlook changed? I mean, I think who knew what we were getting, but how do you sit with that now?
So as an economist,
don't go defending yourself already.
Tariffs are taxes. Yeah. And I generally don't like taxes. They distort how people interact with the products and services they use on a day-to-day basis. It distorts, international trade. And so generally, I don't like taxes and I don't like tariffs. That being said, what we got as opposed to what was advertised on Liberation Day was significantly different.
Yeah, exactly. Yeah, significantly different.
Significantly different. I mean, we were expecting 30 and 40% tariffs on, every country around the world.
Yep.
And, we ended up getting 10% baseline tariffs with Europe and the UK and some trade deals here and there. Certainly some more tariffs on China, and the use of tariffs, in ways that tariffs hadn't been used before.
Yep.
But in terms of our analysis of what that would do, I think we were pretty close, and we were close because we relied upon banks like JP Morgan and Goldman Sachs and their analysis, delving deep into it, that said that, taking all these tariffs together and the product mix and changes in product mix and how consumers would react, that, ultimately it would be about 0.5% to maybe, 0.75% in terms of the increase to inflation.
Right.
And that wouldn't happen sort of over time. It wouldn't happen all at once. It would happen over time.
Yep.
And I think that's what we've seen, that there have been some price pressures on, the goods side of inflation, but the services side of inflation has been, steady to declining. And we've seen shelter inflation start to roll over a little bit. And so we've actually seen, even though there have been these tariffs, we haven't seen inflation in the U.S. go up. We've seen the inflation rate actually come down. Yeah. And so that's sort of antithetical to what we might have expected, or what a lot of people expected. Right. But tariffs didn't turn out to be the boogeyman that we all expected they would be.
So what's the real effect on GDP in your opinion? You hear so much about it. Is it really making that much of an effect, or is it just the outlining things that have occurred that are helping a little bit? I mean, what's your opinion concerning tariffs into GDP? Help, hurt, indifferent?
I think the main thing, as I think about, where pressures were going to come from before tariffs versus where they're coming from post tariffs, is really in the U.S. government deficit. We've seen the deficit come down substantially as a result of that. And that means the U.S. government isn't going to need to borrow as much money. Now, this is all before the Supreme Court comes back with whatever ruling they're going to come with.
Whatever.
We don't have access to that yet.
Right.
They're still trying to figure out how to thread the needle. And I'm not a lawyer, and you're not a lawyer. We don't know how that works. But
exactly.
But the U.S. government budget deficit has come down dramatically as a result of incoming revenues from tariffs, and that means that interest rates don't have to go, or long-term interest rates probably don't need to go up as much as they did, because the government isn't borrowing as much as it might have otherwise. I think that has a big impact on the way that we view the world, especially as we, go back to that first discussion we had about interest rates. If interest rates don't have to go up as much, that means, if interest rates go down, valuations go up, very simplistically. So if interest rates don't have to go up, then valuations don't have to go down.
So where do you see the consumer? Well, first, before we talk about confidence, talk about business confidence. And where are businesses right now in all this compared to maybe this time last year?
I think businesses are, we have to bifurcate it, sector by sector. And also by large businesses who have pricing power and smaller businesses that maybe don't have pricing power.
Explain what you just said by buying power versus those who don't.
So certain businesses or certain companies can raise prices, and it doesn't matter. People will still buy that product.
Example,
Coca-Cola.
Okay.
Coca-Cola can raise the price of their syrup, and it really doesn't affect how much Coca-Cola people are consuming.
Right.
One of the great reasons why Warren Buffett, bought so much Coca-Cola stock. Other types of companies, raise their prices and people stop buying.
Right.
Look at furniture companies.
Mm-hmm.
They can't necessarily raise their price because people will just decide not to buy furniture
Exactly.
or clothing or jewelry, things that aren't, essentials.
Right.
And when we look at, smaller businesses, they are having a tougher time raising prices. And so, but that means that instead of growing revenues by double digits, they're only growing revenues in the high single digits.
Right.
So it's, when we look at the economy, that's why, we're still kind of bullish. Is that yeah, things aren't 100% fantastic, but they're also not bad.
Right. So let's talk more specific. What about the financial services areas, banking and stuff? Because you were one of the first ones that said if banks can make money or at least break even when interest rates are where they are, I certainly believe we need to advance more into that sector as interest rates come down. Where are you now when it comes to the financial sector?
So the financial sector has done great over the past year. And, we were very big into investment banks in client portfolios this year. So Goldman Sachs, Morgan Stanley, JP
Right.
Morgan did fantastic. And, one of the things I think that's going to happen this year is that interest rates on the short end, maybe not in the first half of the year, but in the second half of the year, are going to decline again. We can talk about the politicization of the Fed and politics, but President Trump is probably going to get the nominee for Fed governor or for Fed chairman that he wants, and a couple of governors that he wants.
Right.
And we're probably going to have lower short-term rates. I also think that because the economy is doing well in that environment, and there's tailwinds for the U.S. economy, that longer-term rates are likely to go up.
Mm-hmm.
And so what that means when short-term rates are down and long-term rates are up, you have a steeper yield curve.
Right.
And a steep yield curve is great for banks because what do banks do? They borrow on the short end and they lend on the long end.
Right.
And so it means that banks are going to increase their net interest margin or their general profitability. And so banks should do well in that environment, especially since the U.S. economy is still growing. That means there aren't going to be a lot of credit losses. And there's going to be lots of opportunities for ancillary services and growing their customer bases. So well-run banks should do great in that environment.
Well, let's assume that works well in credit card world. If interest rates do come down, inflation's coming down, people can make their payments. But what about capping? What they're talking about capping interest rates, I see that as a steep dive. That seems to me, I don't want to call it a crisis, but I call it a fundamental risk. How do you see that?
One, I don't think it's going to happen.
Okay. Averted crisis. How's that?
Another averted crisis. Yeah. I mean, but seriously, we saw the stocks of, major banks decline in the face of this idea that somehow the president of the United States was going to be able to force banks to cap credit card rates at 10%. One, we know from Nixon and we can go back as far as ancient, Mesopotamia probably. Anywhere price controls have been tried, they fail. They produce many more problems than they attempt to solve. Yeah. So price controls just don't work. It's a bad idea. Will there be some companies? Wade, my guess is that there's a couple of companies out there, and I think we even saw one. Built was one, and a couple of other, and probably some of the other banks are going to come out with a gimmicky 10% credit card, and guess what? No one's going to be able to get it. No one will actually qualify.
They're not. That's exactly. I had a conversation with a bank CEO yesterday, and we were just kidding around, and I said, "So how do you feel about the credit card cap?" And he said, "I won't be in the credit card business." They can't take the risk, right? There's too many default ratios on that are sort of baked into the whole process that I think a lot of consumers don't understand. But from a financial aspect, I don't see that. I hope it doesn't happen. Let's just put it that way. Let's talk about capital investments. And, I'm starting to see more, money being thrown back into the supply chain and the manufacturing. What do you see for 2026 moving forward in that direction?
I think there's been a lot of commitments made by companies to invest, both U.S. companies to invest in the U.S. and foreign companies to invest in the U.S.
Right.
And I think what you're seeing anecdotally is probably right on track. That it takes time.
Yep.
You don't just build a giant factory overnight.
Right.
You don't just build a data center and populate it with chips and everything else that goes in there, in 3 months. Right. These things take time, and they're starting, and they're going to continue, and they're going to be helped by the expensing and depreciation rules in the One Big Beautiful Bill Act, the tax bill that was passed last year, that encourages business investment. I
agree.
When the government wants to encourage people to do things, people respond to incentives. That's something that I took from business school and have always sort of applied to any analysis of a company or the economy. Where are the incentives? Because people respond to incentives. And if incentives are out there for them to do bad things, they're going to do bad things. And if incentives are out there for them to do good things, they're going to do good things. Yes. But you can't blame people for acting in their own, self-interest. That's what we want them to do. So,
I would agree.
But in this case, people are in businesses, companies, whether they're foreigners or U.S., are incentivized to build, and they're going to build.
Yeah, and we're seeing that even locally. We're seeing, which we've kind of cautioned our small business owners. You're competing with a lot of growth that's going to be coming, and if you see that growth, you better be advancing your plans forward. The square footage necessary for their expansions into their manufacturing plants and their lines, and certainly we're seeing some problems with commodities when it comes to that. Do you want to touch on that a little bit?
Yeah, I thought that's where you might be going, because I think that's one of the reasons that we're seeing the commodity complex start to have a bunch of increases in price.
Right.
There's just like it takes time to build a building, it takes even longer to open a new mine, or and to get stuff out of the earth and process it. We didn't do a lot of this stuff in the U.S. for sure, and then we weren't incentivizing it like we are today, or there wasn't maybe a geopolitical need or a sensitivity to the geopolitical need to build it in the past. And so, mining companies just didn't put a lot of money into that infrastructure. Yeah. And so, you're seeing the price of copper go up. And silver. You're seeing, silver, gold to a lesser extent from an industrial standpoint. But you're seeing platinum, palladium, all of the metals, I think, are responding to that.
Yes,
we're in a couple of steel companies in client portfolios, and we're seeing the price of steel, I think, start to go up a little bit too. But I think that the one big commodity, oil, that's a totally different totally different situation.
Hey, Gary, well, this conversation is going on a little longer than I anticipated, and it's great information. So, I think in honor of what we're trying to do with this podcast, keep it short and sweet. I think if it's okay with you, we'll end it here, and then we'll come back with part 2 immediately following.
Sounds great.
Thanks for spending time with us today on Built to Last. If today's conversation helped bring clarity to your thinking around wealth, work, or life, that's exactly why we do this. Till next time, stay focused on building something that truly lasts.
This podcast is produced by Concord Wealth Partners, LLC, an investment advisor registered with the Securities and Exchange Commission. Registration does not imply a certain level of skill or training. The information presented is for educational and informational purposes only and should not be construed as personalized investment, financial, tax, or legal advice. Nothing discussed should be considered a solicitation or offer to buy or sell any security or investment product. All investing involves risk, including the potential loss of principal. Past performance is not a guarantee of future results. Individual results will vary based on personal financial circumstances, risk tolerance, and other factors. Concord Wealth Partners does not provide tax or accounting services. Tax and accounting services are offered through Concord Business and Tax Advisory, an affiliated CPA firm. For more information about Concord Wealth Partners, including our Form ADV Part 2A and Form CRS, please visit concordwealthpartners.com or contact us at 800-838-4370.